Hello, everyone, and thanks for taking the time to listen to Alternative Angles, a podcast series where our guests represent a wide range of expertise across the entire alternative investments landscape. I'm Chris Pariseault, Head of Institutional Portfolio Managers at Fidelity Investments, and your host for Alternative Angles. In each episode of this podcast series, we'll get to know the people who make investment decisions in highly complex alternative investment strategies, but strategies that are becoming increasingly vital components to well-diversified multi-asset portfolios. For this episode of Alternative Angles, our topic is venture capital, and our guests are Karin Fronczke, Global Head of Private Equity for Fidelity Investments, and Mike Maples, co-founding partner at Floodgate. Good afternoon, and thank you both for taking the time out of your schedules to be with us today.
Thanks,
Thanks for
Chris.
having us.
We're really excited about this episode for a lot of reasons. Karin leads our global private equity team at Fidelity, where we have had a long track record of venture capital investing. And Mike, who is the founder of Floodgate, just published a book called Pattern Breakers, which we have read and enjoyed very much. And while it's true that Mike and Karin play integral roles in the evolution of capital allocation and corporate business formation, they're at two different ends of the spectrum. So Mike is at the pre-venture capital stage or seed stage where founders will look for funding to get the company off the ground. Mike and his partner, Ann Miraco, have been doing this for almost 20 years, working with startups that are now collectively worth over $1 billion. So we'll discuss what Mike looks for in his process and how he evaluates opportunities. And as his book suggests, he is looking for pattern breakers. So businesses and ideas that are not conventional or incremental, but ideas that live in the future. Karin and her team, on the other hand, are late stage venture capital investors. And at this stage, she's more interested in established patterns or being pattern followers, looking for trends that shape her opinions on whether a company is disruptive or unique. She has a rigorous process to make that determination, which we'll discuss. And her team may engage with over 1,000 companies on an annual basis, but may only invest in roughly 5% or less of those companies. And Karin oversees roughly 18 billion in private equity across Fidelity Investments, including Fidelity's Venture Capital Fund 1. So it might then follow that companies that are potentially seeded by Floodgate could make their way to Karin's team. And after we get to know Karin and Mike and what drives their approaches, we'll close with an example of how it all fits together. So with that introduction, Karin, and maybe before we get into what you're doing now, maybe you can share a little bit about how you got started in this business. Specifically, what was your path to venture capital? Were you set on it from the start, or did you take another less direct route?
Certainly a more circuitous route than most. I'll start with my upbringing only because it was pretty formative in what I look for in people and specifically founders. I grew up in a small town in Western Mass. My dad was an electrician who owned and ran his family business. I only mention it because, like I said, it really helped create what I look for in founders. My dad was a really hardworking, kind of scrappy individual with the highest levels of integrity. And that has unequivocally shaped the qualities I look for in founders today, along with a key sense of mission, which I know Mike will talk a lot about as well. Kind of fast forward to my adult life, I was a banker for about 16 years at JP Morgan, where I spent most of my time raising equity for companies, bringing companies public. And it was really the perspective of what does it take to be a really successful public company worth potentially hundreds of billions of dollars in the future. That was kind of the key training I had when I took this role at Fidelity. And now just with a different lens as an investor as opposed to an advisor. And really what I'm looking for and what the team's looking for is to back companies that have the potential to be the next member of the Magnificent Seven, worth trillions of dollars, if not more. Um, why venture capital? Why I love it? Why I love my job? A little bit more of a personal lens as well. I have four very little kids at home. And what I love about venture investing is I feel as though I get to play my small part in backing companies that will make the world we all live in cleaner, safer, healthier, kind of more productive for both my children and, of course, the generations to come. So that's my backstory.
Thanks, Karin. Mike, maybe can you talk a bit about your beginnings and how you became a seed investor? And what is it about this stage to you that's very appealing? So it's a very different risk reward profile versus late stage.
Yeah, so I've been programming computers since I was in high school. And so I've just always liked computers. I didn't initially think of it as a career. It was more sort of a hobby that turned into something else. And so for a while I was an entrepreneur in the 90s. And then I decided to start investing in startups in the early 2000s, starting around 2005. So I've been investing in startups ever since. My point of departure is a little bit different from some what I would call normal business people. So, when you think about corporations, usually they're trying to build defensible moats. They're trying to compound their advantages in value creation. They're trying to, harness the different powers that give them advantages in value creation. With startups, they have none of those things. They have nothing to compound. Usually all they have when I get involved is the founders and how compelling is their idea. And so these startups, they succeed not because they compound anything or not because they build upon existing strengths. Instead, they succeed by changing the subject. They show up out of nowhere with something radically different that catches everybody by surprise, and then they try to create a radically different future rather than a new and improved future. And so I invest at that crazy too early, way too early, or sometimes even legally ambiguous phase when we're not quite sure what this thing might become, but we hope that it has a set of traits that give it the powers to, overcome the pull of the present and do something radically different.
So, Mike, in an earlier conversation we had, you said that there's a generational transition on the perception of startup capitalism and kind of the where we are today. Can you talk a little bit about that?
Yeah, so I think that's one of the things that I think I've learned is that a startup capitalist is a different kind of capitalist. And so, you know, let's call it corporate capitalism or how we normally think of it. We think of it as a company that's got shareholders in a product and they're trying to compound their advantages. And when you make a bet on one of these companies, you're betting on their ability to persistently compound more than the wisdom of the crowds thinks they will. Startup capitalist creates value by changing the subject. And so, why does that matter? Well, when I was when I was programming the IBM PC when I was a kid, the CEO of GE was Jack Welch. And if you'd asked me who's the most famous business person in the world, that's probably who I would have said. Uh, I don't know who the CEO of GE is now. I don't think I know who the CEO of IBM is or Coca Cola or any of these companies. And I knew who those people were when I was in high school. Whereas like my kids, when we drive home in my Tesla and we trip over Amazon boxes walking up to the front door, my kids know who Elon Musk is. They know Jeff Bezos is. And they knew who Steve Jobs was. And so what I started to realize was that the startup capitalists, the pattern breakers, were starting to not only succeed in terms of being prominent business people, but they were starting to define the rules of business and even in culture in some cases. And so they're starting to have more of an outsized impact in the 21st century than they once did. And so even if you don't want to invest in startups, you might be affected by them regardless of who you invest in.
In your book, you talk about pattern breakers, so who you define as unreasonable people that have unreasonable ideas, which is an interesting take, and you want to back them before the rest of the world, obviously. So can you just describe a little bit about why this is important and sort of once you've found that unreasonable person or idea, maybe just a very high level overview of your process to start with?
Yeah. So one thing I will point out is that um, what we're describing here is not just true in capitalism. It's true in science. It's true in philosophy, lots of fields. So, in science, when Copernicus proposed that the sun was at the center of the solar system, not the Earth, he was put under house arrest. And the church didn't agree with his point of view for another several hundred years. And so a lot of times new ideas seem heretical at the time because we as humans are used to following the current pattern. And we follow it so much that we're not even aware that we're following it. We're not even aware that following a pattern can introduce a bias to our thinking. And so the reason that I think startups and startup capitalism are so important is that you need, what George Bernard Shaw once said, that the reasonable man adjusts to the world, and the unreasonable man makes the world adjust to him. And so therefore all progress depends on the unreasonable man. And so you need those people from time to time. You don't necessarily want them running the biggest division of a corporation, or you don't necessarily want them to get the vote all the time, but occasionally you want somebody to introduce something radically different that propels humanity forward. And only by being radically different can you make a radical difference. And so, that's kind of why I think it plays an important role beyond just making money and buying low and selling high and that kind of stuff.
So, Karen, you're looking at late stage private companies. By the time you're interested in the companies like the ones Mike has seeded and make their way through the stages of venture capital funding, you're looking for established patterns. So, exactly are you looking for by the time you're interested? What is your process?
Yeah, that's right. I mean, in putting this podcast together, we all kind of joked, love Mike's book, Pattern Breakers, but I'm a pattern follower. Should we be doing this together?
Yeah.
But that's exactly right. You quoted one of my favorite quotes from the book, which was Mike said, "My job is to back unreasonable people who have unreasonable ideas long before the rest of the world believes in them." I and my team and Fidelity, we're looking to invest in companies after the world has started to believe in them, but there's more room to grow. Mike was just talking about compounding growth. We're still looking for companies where we believe the world has kind of adopted their product or service and has reached some semblance of escape velocity, but there's a lot more room to grow. And so, really, our North Star in investing in private companies is, the company has that demonstrable product market fit in either their product or service. Customers are using the product and finding real value in it. A very large total addressable market, just the sheer size of the pie is very large, and a company where we believe there's a pretty durable competitive moat. And lastly, Mike talks about backing the unreasonable founder, which I think is completely necessary at the early stages for the reasons he just outlined. But we're actually looking to back a management team, although mission oriented, highest levels of integrity. But that's actually a pretty reasonable management team because, again, the business has scaled, and we want to be backing a management team that we believe is reasonable and seasoned enough that they can actually take the company public in the not so distant future.
So, when you think about the process that we have, when you think about what Fidelity brings to the table in terms of its competitive advantage and arguably a very competitive venture capital field, what makes your approach differentiated? How do you think about your approach and the differentiation that you can bring to the table?
It's interesting. I was actually listening to about a year old podcast this morning, Invest Like the Best, on my walk to work. And the guest was a gentleman named Jeremy Giffen from Tiny. And he said, quote, investors often have a difficult time articulating exactly what their edge is. So I'm really hoping I don't fall into that bucket as I go through it here. But I do think humbly that Fidelity has a pretty significant edge, a sourcing advantage, a diligence advantage, and a track record. And I do think we're kind of uniquely positioned in all three, but let's kind of go through each of them. When you start with who Fidelity is as an investor writ large, we are one of the world's most respected long-term equity investors with a 75-year heritage. We have over $1 trillion of equity assets under management that we're looking to invest in the world's just simply best public and private companies. And so we do sit in a pretty unique position where founders and other venture capital investors very much want us to be investing in their companies before they go public. And, why do you ask? Simply, we have duration of capital. The vast majority of our 17, $18 billion of private investments sit within our mutual funds. So we don't have required distributions for our LPs, at the time of an IPO. We're almost never the seller at the IPO. And in fact, we're almost always a significant buyer. We were a top three buyer in 90% of the IPOs of our private companies in recent years. And we have north of $1 trillion to put to work in those companies if they continue to execute. So, we really are advantaged in that the founders and the earlier stage venture investors in the cap table very much want Fidelity to become a shareholder before those companies go public. And that really adds to our access edge. That's kind of pillar number one. Pillar number two is diligence, as I mentioned. Who has an edge on diligence, one might ask. But we have a dedicated private team that looks at every private investment. But we are blessed to have a literal army, over 200 research analysts here at Fidelity that work with me and my team on diligencing every one of our private opportunities. And they help us understand market dynamics, the size of the market, competitive landscape. And basically, we have what very few traditional VC shops have, which is a pretty intimate understanding of the public markets and the public players. And that really helps inform our view.
And the last part of our track record is that we've been investing in private companies for over 15 years. We first invested in Facebook, now Meta, in 2011 at a $60 billion valuation. And we've deployed over $30 billion across 600 investments. And so that really leads to that pattern recognition we were talking about before in trying to identify the winners and avoiding the losers. So hopefully I've aptly articulated our edge here at Fidelity in regard to investing in private companies.
Yeah, I think you have. And maybe just coming back to the diligence piece for a second. So when I was talking to one of your analysts, they were making the point that, you know, other sort of traditional private equity shops maybe making relative comparisons to other private equity investments, but the bar for Fidelity is not only other private equity investments, but also public. And so there are a lot of dynamics when pitching a particular stock or a particular opportunity where it's not just one universe, it's the entire investment universe that has to be the hurdle in order for this particular investment to be outstanding. Is that fair?
That's exactly right. Again, because the bulk of our $18 billion of private investments sit within the mutual funds, the relative benchmark is I can invest in private companies or public companies, and that bar is incredibly high. And we say it's either a home run or a pass. Now, we never know, but we either expect it to be a home run, a generational company worth a lot of money in the years to come, or we pass.
So, Mike, your book is broken down into two parts, and it's such a great read because you go from the theoretical to the practical. You start with ideas, and then you get into execution, which is a really nice flow, and sort of those tactics to make breakthroughs real, along with a clear track record of success with numerous examples that you've put forward in your book. And it would seem to most people who come up with ideas and are thinking about whether that idea has been tried before, and if it has and it didn't work, then what's the use of pursuing that ideas? I mean, you could think of a litany of different examples where that happens. But to quote your book, you say conventional thinkers often maintain that if something was tried in the past and didn't work, then it's already been proven not to work. And you say the key question to ask isn't whether an idea has been tried before, because it probably has. But the important question is, why is now the time it's going to work? And then what inflection has emerged that makes this time different? So maybe first, can you define what an inflection is and why it's important?
Yeah. So I like to say that business is never a fair fight. The only question is who gets to fight unfair. And in the default, the incumbents are going to get to fight unfair because they have the advantages of the incumbency. So a startup has to have some way to change the subject because better doesn't matter when you're a startup. If you're better, that means you die or you lose because you get caught in the comparison trap. And if you're a customer and you have a choice between a startup's offering and a next best good enough from an incumbent offering, you're going to go with the incumbent because it's risky, less risky, and it's good enough. So back to inflections then. Inflections allow the startup to fight unfair. So for example, when ride sharing happened, the inflection was that the iPhone 4S shipped with a GPS locator chip. That was a new thing. Those locator chips hadn't existed before in smartphones. And so that answered the why now for ride sharing. Now, for the first time ever, you could locate riders and drivers algorithmically and help them spot each other in real time. You could have had the idea for ride sharing. In fact, many people did years before, but it wouldn't have mattered because you wouldn't have able to implement a system that embodied that vision. And so what you want with an inflection is you want to take advantage of some new form of empowerment, and you want to use that new form of empowerment to create a radically different product that changes how people think, feel, and act, and that causes them to say, "Oh, I can't go back to the old way. I can't unsee the new thing." And so that's what happened with the Lyft guys and with Uber is they understood, oh, with this iPhone 4S, that means you can do what Airbnb did, but for cars, because now you'll be able to treat riders and drivers like they're hosts and guests. And that's the second part, right? So the inflection is married to an insight, and the insight, rather than being external to the startup like the inflection is, it now is internal to the minds of the founders. It's where the creativity of entrepreneurship really comes into play.
So if you don't understand the inflection and the why now, so you could have someone come to you with a great idea, but you're likely to pass on that idea before you even get to the next step, which is the insight, because the inflection isn't ready. The idea isn't ready
It-
yet.
yeah, the way I like to think about it is just like how we think about efficient markets for pricing. I think there's also a fairly efficient market for ideas. And so it's fairly likely that most ideas have been thought of, or most ideas maybe have even been tried. So you got to ask yourself, okay, why would an idea that's been tried before work? To kind of get back to the way you framed it, the way that that happens is an inefficiency is introduced. And so an inflection creates on some level a temporary inefficiency in the market in terms of the capacity of somebody to be able to implement an idea for the first time that could provide radical new forms of empowerment. And so that's what you're really looking for. You're looking for these change events that create a window of opportunity for a startup to implement an idea that for the first time can deliver upon the empowerment that that idea pretends. So my colleague Ann Miraco and I, we like to say, assume every startup idea has been tried, but all of the good ideas will happen. And so the question is just, when is it ready to happen? When are circumstances aligned so that the startup can now, for the first time ever, make that idea real and transform the future?
And you've said in other forums that it's kind of important to have, so if you have the inflection and you have an insight, but the insight doesn't work, it's important to be able to be flexible and to pivot.
Right.
Maybe talk a little bit about that.
Yeah. So let's suppose that I have an insight about the future. I think that you know, applications that can algorithmically locate people will transform the future. Well, there are lots of different ways that you can implement that insight. So Lyft and Uber implemented a ride-sharing platform. Instacart implemented grocery shopping, but just like Uber and Lyft, you couldn't have done Instacart without the ability to locate people in real time. Same is true for DoorDash. And then yet again, there are other implementations that don't find product market fit, but they're still right about the potential for this new thing to provide new empowerment. So what happens in those cases occasionally is the founder pivots the idea to a better idea. Like, so the case of Lyft, it started out as Zimride. It was a corporate commuting service, but then when the iPhone 4S came out, they pivoted the idea to peer to peer because they realized that the inflections allowed them to broaden the potential of what they were doing. So the founder is living in the future. They're leveraging these inflections, and what they're trying to do is get early customers to adopt their ideas. And as they interact with those customers, they learn how to dial in the value proposition and the implementation of their product. but it's that first mover advantage into the future that gives them the ability to learn things that other people aren't learning yet, discover the undiscovered before other people discover it.
So, Karen, as you work with firms like Floodgate and your entrepreneur network, when you see what Mike is doing and others in sort of your network, how does that influence your thinking? How does that sort of how do you take into account directionally the things that they're looking at and sort of the universe that you're able to pick from?
I mean, first, let me say I do have an immense amount of respect for those that are either founders or backers like Mike at the earliest stages of pattern breaking businesses, because backing a founder and an idea is a very different type of investing than what I do. And I have the highest level of respect for those people. A teammate of mine shared a quote that I love by the author William Gibson. The quote is, "The future's here, it's just not evenly distributed." And our team tries our very best to stay close to the early stage investors that we respect, like Mike, since they are quite literally living in the future, if you will. And so what Mike and others at the earlier stage invest in today might be relevant to us at Fidelity in 5 or more years. And to be able to have a really large heads up on what might be exciting at our stage, the growth stage in 2030, if you will, is a huge advantage. At the heart of it, venture investing is a relationship business, whether you're at the seed stages or at the late stages like myself. And we at Fidelity feel extremely lucky and humbled to have relationships with many funds that come into shareholder cap tables well before us, and can not only vouch for who we are as a partner and a shareholder and an investor, but also those that have the willingness to share their own history with that particular company. Because even the greatest winners, the greatest companies in the world, don't follow a linear trajectory. They face obstacles, and how the management team and the founder and the business navigate those challenges, obstacles, or as Mike talks about in his book, even sometimes pivots, is really integral and insightful to our process. So, that's really how we interact with the early stage venture ecosystem.
And based on some insight into recent deals, so it might sound like, you have a deal in front of you, you do your due diligence, and then maybe in a couple of weeks you come to a decision. But you might spend a year, maybe more, with founders, management team, lead investors, partners, before you get confidence, and only if you get confidence in that particular deal, right? Because it's either a home run, as you said earlier, it's either a home run or a pass. There's no singles or doubles. You're not looking for singles or doubles here. So
Exactly.
it takes time.
Exactly. And we try very hard, and we make a concerted effort to steer clear of those types of processes, which were frankly, relatively, they occurred quite frequently in 2020 and 2021. And at the risk of sounding like a broken record, because I just said it, venture investing is a relationship business. And the best way to build conviction in a business and in a team is to spend months, if not years, with them. And so that's what we very proactively try to do. We try to identify markets and companies and themes that we're excited about. We lean on and leverage our VC ecosystem for introductions to those companies. And we try to get to know them well in advance of any potential financing. And then we can kind of look back with the benefit of hindsight and say, did they do what they said they do? Did they hit the milestones they set out to hit? Did they hit the financial metrics they projected? And it really just kind of builds that credibility in both the management and the business. And if we have the benefit of the time with them, we have more conviction if it's going to be a home run. But it's also why our at bats are so high in terms of the funnel of companies we evaluate and the number of companies we ultimately invest in, which you commented in, Chris, at the outset of the podcast.
Yeah. So so Mike, when in your book you talk about um, the difference between what you do and what other investors might do is there could be a founder that is coming to you with an idea that could be an incremental improvement to the way things that are done today in terms of sort of convention. You're not looking for that. You're looking for your founder's audience or your or sort of what you call co-conspirators to force a choice and not a comparison. And you use the example of Tesla. Can you talk a little bit about that?
Yeah. So, and probably a more recent Tesla example might be the Cybertruck. So maybe we'll go with that. So I don't know about you all, but when I first saw the Cybertruck on stage and they threw the rock in the window and broke it and stuff, at first I thought maybe Elon Musk was joking. Um, because I just, I was like, are they really going to release that? Uh, but sure enough, they did. But like the interesting thing to me about the Cybertruck is you may think it's awesome, you may think it's ridiculous, but nobody after seeing a Cybertruck ever says, okay, so how does that compare to a Ford F-150? It's like he forces a choice, choose my vision of what a truck is or don't, be in my future or don't. But like you're never gonna say, oh, well, how's that different from an F-150? Just like when you took your first rideshare ride, nobody ever said how's that different from taxis. It was just so self-evident, particularly in San Francisco, where taxis were terrible, where they're basically non-existent. A lot of other places like it, and so, or nobody said, "How does Twitter compare to blogs?" It was just so obviously different when it came out, and so I think that forcing a choice and not a comparison is about that. It's if you play the comparison game, the problem is human beings are conditioned to like things. And so if what you're doing is too similar to what they already know, then it's too much like what other people have. It's too much like the incumbents, which means that the incumbents are going to have the advantage over you. Even if you're 10% better or 50% better, you're going to play this leapfrog game by their rules. Whereas if you do something radically different, the true test of that is it can't be compared to anything that's ever come before. And so therefore you force a choice in the sense that the customer buys into your idea of what the future is or they don't. But it's either magnetized to it or be hostile to it, but you can't be neutral about it. And so that's the place you want to be as a startup. You don't want people to be intellectually interested in it being slightly better. You want them to be emotionally committed to it being radically different in a way that resonates with them very strongly.
And both you and Karen have used the word future a lot. Karen quoted, "The future is here, it's just not evenly distributed." I think you might have even said that earlier, Mike. And in your book, you talk about living in the future. So founders that are actually thinking one, two, three steps ahead in an effort to solve a problem. Uh, Acknowledgement first that the problem exists, right? So it's not just a problem in the founder's head, but acknowledgement that there is a problem, and the founder surrounds himself or herself with others that are sort of living in the future in order to get to that solution. So Elon Musk seems to spend most of his time in the future, but a lot of founders kind of need to get into that mindset. Can you maybe talk a little bit more about that?
Yeah, so I think that there's a little bit of a misconception about where great startup ideas come from. So I think probably a layperson would think great startup ideas come from people who have better vision than other folks that can see around corners better, that can see the future farther. In my experience, so in watching it happen, it's more about like what Karen was saying. So like let's just take an example. Mark Andreessen, when he was a college student, he was at the University of Illinois in a supercomputer lab, and they lowered this supercomputer with a crane and then built the walls around it, and it had a really fast network, and the NCSA had funded it. And he started tinkering with the early technologies of the World Wide Web. Vint Cerf, Tim Berners-Lee had just come out with the World Wide Web standards, and so he started having difficulties as he was trying to make the internet useful for him. And so it was the encountering those difficulties that caused him to come up with a good startup idea, namely the Mosaic browser, which became Netscape. And so um, the reason that's important is that if I just try to think of a startup, I'm going to tend to look for ideas that exist in the present. I'm going to look for customers, conventionally minded people who have problems with conventional issues. But when I live in the future, two things happen. One is I see firsthand how an inflection or set of inflections changes how I can think, feel, and act. I literally witness a new pattern right in front of me, because when I tinker with the future, I start to see what's new about it. And when I see what's new about it, I also see what's kind of incomplete about it. And when you build what's missing in the future, your intuition about what to build is far more likely to be right. And so, Mark wasn't trying to build for a browser market. Mark was trying to make the internet immediately more useful for him. And in so doing, he kind of discovered the market, the product defined the market. But conventional minded thinkers at the time would have thought that the digital superhighway, which it was called, was going to be designed by either Microsoft with MSN or AOL with its walled garden, or by the US government, or by Time Warner, or by AT&T. All of the conventionally minded business people were debating which big player would play the leadership role in this digital superhighway. Nobody imagined that some kid making minimum wage in a supercomputer lab was going to have the right new pattern, that it wasn't going to be a tops down network. It was going to be more like, in fact, the very idea of a digital highway was wrong. It was more like this messy web that sprung out of lots of different places and connected in different unexpected and emergent ways. And so, that's a really good example living in the future. And because Mark's lack of business awareness was an advantage for him, because he didn't have to unlearn that the digital highway was the wrong-headed metaphor to think about this, right? All he knew was what was in front of him. He didn't even know how to run a business at the time. And so that's quite often what we see, is that these startup ideas come from people living in the future. And Karen's right. It's already here. It's just not evenly distributed. And pockets of the future visit some people before they visit the rest of us. And some founders are open-minded enough to identify what's powerful about it and what's missing about it.
Fascinating, fascinating. So before we close, I'd like to talk about a deal that you are both involved in, which is Applied Intuition. So Applied Intuition software solutions, in a nutshell, really help automakers, suppliers, companies across trucking, construction, agriculture industries navigate the transition from AI, software development, and bring vehicles to the market safely, and sort of upgrade the technology, and sort of electric vehicles, and so forth. And Mike and Karin can build on that. Some of the products include simulation tools, data, tool sets, etc. So now, as we've learned, you're both looking for different things across the stages of venture capital. So maybe, Mike, let's start with you. What is it about Applied Intuition that you saw as a pattern breaker?
Yeah, and I think I can also connect that to some thoughts about working with Fidelity. So basically, at the time, so I got to know Kasser Yunus, who's the CEO, and I probably spent about 14 months with him on and off. And he said, "Hey, I'm want to start a startup, but it has to meet a certain set of conditions. It has to be software margins. It has to be leveraging my knowledge of the auto industry, both when I was in Detroit at General Motors, as well as my experience at Google. And I want to have a co-founder who also shares that profile. I want it to be enterprise software. I wanted to take advantage of the new trends in cars." And so he went back and forth and thought of a lot of different ideas until he converged on the Applied Intuition idea. And then the company's done really well. It's private, so I can't say what their numbers are, but it's been very successful, very effective, very capital efficient, for that matter. But you get to a point where these companies start doing well, and you get the later stage money, or even public markets money. But a lot of these people are kind of fast money types. They don't care as much about the company, and it's more about what price can I get in and at, and how fast can I get out of it, and stuff like that. And if you look at Fidelity, I've known of them since early in my career. You always thought of them as, okay, if I want this company to be positioned for the long run, you want people who have access to public capital markets, but you also want slow money types, just like on our LP side, we wanted endowments like Yale, with Swenson and his team, because they were, they expected performance, but they were patient for it. And in fact, one of their competitive advantage, I think, was that they were slow money, that they were prepared to hold a stock for a long time, and not just try to trade it really quickly. So I think that that's kind of how we started to, Fidelity started to get on our radar screen. I'm sure that you know me getting on your radar screen is more of a function of just I was involved with the company, right? You're probably analyzing the company, but it was, it's kind of, I think that's where our approaches are pretty convergent. I think both of us are kind of slow money types. I back these companies with an idea of holding the stock for a long time. In fact, I usually can't get out of the stock even if I wanted to. But then in the upstream capital markets, you have a wide range of short termers in it for the quick trade versus people who really want to own a part of the business for a long time, and be a major part of the story and a major partner in the growing of the business.
Karin, how
So
did you and the team get involved? Sorry.
well, first I was going to say you heard it from the horse's mouth, Mike himself. The duration of our capital is part of our unique edge, and being slow money that accrues to our benefit with VC investors, as you heard from Mike, and truly from founders as well. So listen, Applied, we had, it fell within a lot of our thematic research, and in particular, our view thematically that cars would have a software enablement, really across the board in the future, and our belief that potentially the more typical OEMs might not be the best positioned to get their own vehicles software enabled. And so it fell kind of right within the lines of some of the themes that we were excited about as it related to autos in particular. But then as we got to know the company, thanks to both Mike, but also Mary Meeker at Bond Capital had put us in touch with Kasser, we realized it really kind of hit all the core tenets of our investing: an extremely large market, demonstrable product market fit. And to us, that was really kind of demonstrated by its contracts with 18 of the top 20 global automakers, including Porsche, a pretty durable moat, and a great management team. Kasser's a true legend and a wonderful person. And lastly, kind of cherry on top, Mike mentioned it, capital efficiency of their business model. And, the beauty of us being able to work with Mike on this is, as I mentioned before, not every great company has a positively linear trajectory upwards. There's always fits and starts, there's always some hardships, but understanding the backstory and how a founder and his team kind of overcame obstacles over time really helps us build the conviction. And that was immensely valuable to us. And so thank you, Mike, for both the introduction as well as working with us on the deal. Ultimately, Fidelity did invest in Applied, both via some of our mutual funds. But Chris, you mentioned it, our inaugural Fidelity Venture Capital Fund One also invested in Applied, which I think is just a testament to our excitement for the company and what they're continuing to build. Quickly, I'm going to use the last second, if I may, Chris, just to spend a second on the Venture Capital Fund One, which I don't think we've spent too much time talking about in this podcast. I'd mentioned our history at Fidelity of investing in private companies over the last 15 years and deploying $30 billion plus of capital into private companies. Historically, we've done that all via our public mutual funds. They all have, not all of them, the majority of them have small positions in private companies. But given we felt as though we had those three pillars I talked about before, kind of unique sourcing advantage, really rigorous diligence, and a track record, we made the decision earlier this year to launch a fund exclusively to invest in private companies. And we launched mid-May, hit our fundraising cap in less than 4 months, which we were all incredibly proud of, especially given the backdrop of what has been, frankly, a more tenuous fundraising environment. But I think that just speaks to our advantages here at Fidelity investing in private companies. And so far, we've deployed about $30 million in 9 companies, including Applied, of course. And we're pretty excited about the investing opportunities ahead. So heads down, looking for the next great companies to get not only into this fund, but our mutual funds too.
Excellent, Karen. Well, Mike and Karen, thank you both. It has been nothing short of enlightening to hear both of you talk about your roles in the startup and venture capital ecosystem. So again, really appreciate the time you've taken to join us today. This has been Alternative Angles. My name is Chris Pariseault, and thank you for listening.
This podcast is intended for institutional investor and investment professional use only. Information provided in and presentation of this document are for informational and educational purposes only and are not a recommendation to take any particular action or any action at all, nor an offer or solicitation to buy or sell any securities or services presented. It is not investment advice. Fidelity does not provide legal or tax advice. Before making any investment decisions, you should consult with your own professional advisors and take into account all of the particular facts and circumstances of your individual situation. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in these materials because they have a financial interest in them and receive compensation, directly or indirectly, in connection with the management, distribution, and/or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Views expressed are as of October 2024 and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Some of this information is forward-looking and is subject to change. Past performance is no guarantee of future results. Investment results cannot be predicted or projected. Information provided herein is for informational purposes only and is not a recommendation or an offer or solicitation to buy or sell any security or for any investment advisory service. Alternative investments may not be suitable for all investors and are not intended to be a complete investment program. Alternatives may be relatively illiquid, it may be difficult to determine the current market value of the asset, and there may be limited historical risk and return data. Costs of purchase and sale may be relatively high. A high degree of investment analysis may be required before investing. Fidelity Diversifying Solutions LLC is an SEC-registered investment advisor, a registered commodity pool operator, and registered commodity trading advisor. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR, and FDS. Fidelity Investments, Institutional Investor, and Floodgate are not affiliated. The Fidelity Venture Capital Fund 1 is closed to new investors. Fidelity Investments provides investment products through Fidelity Distributors Company LLC and clearing, custody, or other brokerage services through National Financial Services LLC or Fidelity Brokerage Services LLC, members NYSE SIPC.